Hello and welcome. If you're here, you're probably wondering how to make your money work harder. Investing can seem complicated, but it's really just a smart way to grow your savings over time. You don't need to be a financial expert, just curious and willing to learn. Think of investing as planting a seed. With patience and care, it can grow into something substantial. Your money, when invested wisely, can help you reach goals like buying a home, retiring comfortably, or gaining financial security. We'll break down the basics, using simple examples and no confusing jargon. By the end, you'll have a clear picture of your options and what might suit you best. Remember, every expert investor started as a beginner. Let's take the first step together. Investing isn't just for people in suits, it's for everyone. So relax and let's get started on your journey to a brighter financial future. Ready? Let's dive in. Why invest at all? Isn't your money safe in a savings account? The truth is, inflation slowly erodes the value of your money. What you can buy today will cost more in the future. Investing helps your money grow faster than inflation, protecting its value over time. Savings accounts offer low interest, often not enough to keep up with rising prices. Investing puts your money to work in businesses and projects that grow, giving you a chance to build real wealth. It's the difference between letting your money nap and sending it out to earn. Thanks to compounding, where your returns earn returns, small, regular investments can grow into something big. Start early, even with small amounts, and give your money time to grow. Investing is about building the future you want, not just for you, but for your family too. That's why investing matters. Let's talk about stocks, also called shares or equities. Buying a stock means owning a tiny piece of a company, like getting a share of your favorite coffee shop. If the company does well, your stock's value can rise, and you might get a share of the profits, called dividends. But if the company struggles, your investment can lose value. Stocks can be a roller coaster, exciting but risky, especially in the short term. They're best for long-term investors who can handle ups and downs. Spreading your money across different stocks helps reduce risk. Stocks offer the potential for high growth, but you need patience and a strong stomach for volatility. Remember, you're sharing in both the successes and failures of the companies you invest in. Don't put all your eggs in one basket. Diversify. Stocks give you a direct stake in the economy's growth. For many, they're a powerful part of a long-term investment plan. Now, let's look at bonds, the calmer, more predictable side of investing. Buying a bond is like lending money to a company or government in exchange for regular interest payments. Bonds are generally more stable than stocks, offering steady income and less dramatic price swings. Government bonds are considered especially safe, while company bonds carry a bit more risk. The trade-off? Bonds usually offer lower returns than stocks. They're great for balancing risk in your portfolio and for those who value stability over high growth. Bonds act as a cushion when the stock market gets bumpy. You won't get rich quick, but you'll sleep better at night. For many investors, bonds are a key part of a sensible, balanced strategy. Think of them as the reliable anchor in your investment mix. Let's make things easier. Meet ETFs or exchange-traded funds. Imagine buying a pre-packed shopping basket instead of picking out every item yourself. An ETF is a basket of investments, stocks, bonds, or both, that you can buy with a single click. For example, one ETF might give you a slice of the 100 biggest UK companies. ETFs offer instant diversification, spreading your risk across many investments. They're easy to buy and sell with low fees because most simply track a market index. This is called passive investing. No need for expensive managers. ETFs are perfect for beginners, simple, low cost, and diversified. If one company in the basket struggles, others can pick up the slack. It's a smart, straightforward way to start investing. Mutual funds are like hiring a professional shopper for your investments. You pool your money with others, and a fund manager picks and manages a mix of stocks and bonds for you. Their goal is to beat the market using research and expertise. Mutual funds offer a hands-off approach, ideal if you want expert help. There are thousands to choose from, each with different goals and styles. The downside? Higher fees, and no guarantee the manager will outperform the market. Still, for those who want guidance and don't mind paying for it, mutual funds are a solid option. It's investing made easy, with a pro in your corner. Let's compare our 4 main options: stocks, bonds, ETFs, and mutual funds. Stocks offer the highest growth potential, but also the most risk. Bonds are safer and more stable, but with lower returns. ETFs and mutual funds sit in the middle, offering diversification and less risk than single stocks. Stocks and bonds require more research and hands-on effort. ETFs and mutual funds are low effort. Just pick your basket or manager and go. Costs matter. ETFs and stocks are usually cheapest. Mutual funds cost more due to active management. With stocks, you control every decision. With funds, you let experts or indexes do the work. For beginners, funds and ETFs help avoid emotional mistakes and spread risk. It's about choosing your balance of control, cost, and comfort. Do you want to be the pilot or a relaxed passenger? The choice is yours. Imagine 4 friends, Amy, Ben, Chloe, and David, each starting a garden. Amy picks a rare orchid high risk, high reward, like buying a single stock. Ben plants potatoes, reliable and steady, just like bonds. Chloe buys a pre-seeded salad tray, a mix of plants, easy to manage, just like an ETF. David hires a professional gardener, pays more for expertise, hoping for the best results, like a mutual fund. Amy could win big or lose it all. Ben gets steady results. Chloe enjoys variety with little effort. David trusts the expert but pays extra. Each approach has pros and cons, just like our investment options. The key is matching your style and goals to the right method. Some want excitement, others want safety, some want simplicity, and some want expert help. There's no one-size-fits-all answer. Your investment journey is as unique as your garden. Choose what fits you best. And remember, every garden needs time to grow. So, what's the best investment for you? It depends on your goals, timeline, and how much risk you're comfortable with. Start by asking, what am I saving for? How long do I have? How would I react to ups and downs? If you want simplicity and broad exposure, a low-cost ETF or mutual fund is a great place to begin. Set up a regular monthly payment, even a small one, and let it grow over time. Don't wait for the perfect moment. Time in the market beats timing the market. Start small, learn as you go, and be patient. Compounding works best with time. By taking these first steps, you're giving your future self a real gift. You've got this. Now go make your money work for you.